All right. I'd like to welcome everybody to tonight's presentation. Hope everybody gets a ton of information, and we're going to, be here until we get all or most everybody's questions answered. If you have any questions along the way, please put them in the chat box, which should be along the bottom of your screen. Michael, keep an eye on that as we go. So. With no further ado, I want to welcome you to tonight's first-time homebuyer class. And as a first-time homebuyer, do any of you feel concerned? Do you feel any stress, intimidated, anxious, or uncertain? Again, that's a very common feeling for most. So let me start by first of all defining what is a first-time homebuyer. A first-time homebuyer is somebody who has never owned a home, has had no prior home ownership, or a buyer who has not owned a primary residence in the last 3 years. So if you had owned a property before, you sold it, or you no longer own it, if it's been gone for at least 36 months, you are considered a first-time homebuyer once again. And you may have owned property, but you have not used it as your primary residence. So owning investment properties does not exclude you as a first-time homebuyer. You can be a first-time homebuyer even if you have owned investment properties, as long as you have not used it as your primary residence. So the steps to becoming a homeowner. Step number one is getting pre-approved with our team. We're going to give you a link to our calendar for those of you that want to set up an appointment. You can, we'll put that in the chat. Mike, if you want to go ahead and put that in the chat, here's a link to our calendar. There's different types of pre-approvals. There is a pre-qualification, there is a pre-approval, and then what we call a fast-track approval. We'll go into some details on that as we go. We want to help you find a realtor. We have some great realtors throughout the market area. Want to make sure that you're working with a great agent that can help guide you through this process. One of the things that has come up recently in the industry is a settlement that took place with the National Association of Realtors. We're going to talk about that and how that affects what we refer to as a buyer agency agreement. Once you've been pre-approved, once you've signed a buyer agency agreement, then you would go house hunting with your agent to find you the best house and help negotiate the best offer and the best terms on your behalf. Once you go under contract, there will be an attorney review period, which is it's a resting period, if you would, where you can sit with your attorney, review whatever contract you got into. If there is a problem with that contract, the attorney is able to cancel that contract. We've got a couple more folks coming in. The attorneys are able to cancel that contract for whatever reason during the attorney review period. After that attorney review, there is a home inspection and condo review. Condos have become a hot topic ever since that disaster in Florida. Condos, we have to be, aware of the condo associations as well. There would be a loan commitment that gets issued. So once we take your application, we process it, we submit it to underwriting, and we get a formal approval. That's what we call a loan commitment. And then after that, you get to do a final walkthrough on whatever house you purchased, making sure that the house is in the same condition as when you originally put it under contract. Assuming everything is great, you would then go to the title company, sign all of the legal documents. Then you get to move in. And most importantly, you get to have your housewarming party. So becoming a homeowner is very doable. We want to show you and guide you on how we can make this happen for you. So mistake number one, the biggest mistake that people make in home ownership is not becoming owners, is continuing to rent because you think the cost of owning is more than what it should be. So the cost of continuing to rent versus buying can be up to $248,700, and let me explain how we get to that number. So home ownership enables you to build wealth. According to the Federal Reserve, the net worth of homeowners is approximately $255,000 versus the net worth of a renter is can be as little as $6,300. So the differential is that number that I showed you, the 248,000. And here we can see that homeowners have a net worth which is 40 times greater than those of renters. So what, again, the sooner you can become a homeowner, the sooner you can start to increase your net worth. And we'll show you some examples of what that means to you. So homeowners are able to build wealth over time as they pay down their mortgage and their property values appreciate. The other thing is owning real estate is a hedge against inflation. As things are going up in costs, going up in value, real estate is going up in value as well. So you're able to keep up with that cost of inflation. So here is an example of what took place from 2010 to 2019. Historically, somebody who owned a home in 2010 that was worth $203,000, from 2010 to 2019, that property increased to $254,000. So you can see in 2010, the differential between being a renter and an owner was $203,850 versus $6,010, which was a differential of $198,000. Over the next 9 years, the real estate continued to, the real estate went up in value while the net worth of the renter pretty much remained the same. It went flat. From 6,010, it went up to 6,270, which was basically $260 over 9 years, while the net worth of the homeowner increased to 254,000, and that's where we get that differential. That being a property owner allows you to keep up with the cost of inflation, and the gap between home ownership and renters become even more dramatic. So the path to building wealth through real estate is, asset diversification. That real estate is a tangible asset that is, historically going up in value. It's a hedge against inflation. As inflation goes up, so is the value of your property. It's a stable housing cost. Rent continues to go up, where somebody who is a homeowner, they have a 30-year fixed rate. That payment remains stable in comparison to limitless rent increases that can be happening. Generational wealth, that you own this property for many, many years, and the day that you pass on, you have an asset that you can pass to your heirs. And it's a forced savings mechanism in terms of you have a mortgage on that house. It's a 30-year fixed payment. And that payment remains stable every time you make that payment. Your equity increases. What you owe goes down a little bit. The value of the house goes up a little bit, and is really a forced savings mechanism that's built into that home ownership. So mistake number 2 is not knowing all of your financing options. So we want to, kind of explain, where do mortgages come from? There's agencies, they're pseudo quasi-government agencies called Freddie Mac and Fannie Mae. These are the agencies that basically control a majority of all the mortgages that are written are going to be Fannie and Freddie Mae. Fannie Mae and Freddie Mac. There's also FHA, which are government, federally guaranteed loans by the government. VA loans are for honorably discharged veterans, and USDA loans are available in the more rural areas. We'll talk about those in a little bit more detail. So we want you to know that not all lenders are created equally. So mortgage bankers provide access to most loan programs. Large banks may not offer all loan programs such as FHA, VA, USDA, DPA, which is down payment assistance, and non-QM, that stands for a non-qualified mortgage, which we'll talk about here in a little bit. Banks and credit unions' core business is to grow deposit, mark it up, and lend them at a premium. Banks make money by taking in, let me let some folks in here to the group. Banks make money by collecting your deposits, marking it up, and lending it out to other people, and that's how they make their profit, which is important to know. Your local banks, banks, there's a bank on every corner and somebody has to pay for all of those brick and mortar expenses. And that's typically going to be in the premium that banks charge when they're lending their money. Large banks typically have stricter guidelines. They want to stay inside their lending box. They have a very defined loan type that they're offering, and they have much less flexibility than a mortgage banker might have. And large banks, you're just one of thousands of clients. To them, you're just a number, and the number is how much do you have in deposit? When, again, if you're somebody who has a lot of money deposited at their bank, you're able to have a lot more flexibility. But if you're like the, everyday person like Mike and I, we have to shop around and look to see who has the best mortgage product on the market. So the different types of mortgages that exist, number one is a conventional mortgage. A conventional mortgage is basically a loan which is written following Fannie Mae and Freddie Mac guidelines. There's conventional mortgages that offer renovation lending, which would allow you to get a loan to buy the house and get money to fix it up all in one loan. There's FHA mortgages, which an FHA loan is a loan which is guaranteed by the federal government. The federal government doesn't actually give you the loan. They just guarantee that loan to us, the lender. If you were to default, then they would pay us for our losses or guarantee our losses. There are FHA loans, again, which offer renovation financing, the ability to get money to buy and fix the house all in one loan. We'll go into a little bit more detail on that. There's VA loans. So honorably discharged veterans are able to purchase properties through their VA eligibility. And again, the biggest benefit there is veterans do not have to have a down payment. They're able to get 100% financing. USDA is U.S. Department of Agriculture. These loans are typically done in a more rural area. Very interesting part of USDA loans. Again, they are 100% financing, so no down payment required. And then what we refer to as non-QM, non-qualified mortgages. Qualified mortgage was after the mortgage meltdown in 2008. The lending industry or the government regulations came out with what they referred to as a qualified mortgage. And what the qualified mortgage did, it basically what it does, it actually protects the lender, like myself, which says if we write a mortgage following the qualified mortgage standards, we, the lender, cannot be sued for having given a loan to somebody who couldn't afford it. So we have to have a certain amount of due diligence to prove that whoever we're lending money to we should have lent money to. And if we follow those rules, it's a qualified mortgage, and then we don't have the risk of legal liability. So then they came out with these loans called non-QM or non-qualified mortgage. We still have to lend with discretion in regards to proving that you have the ability to pay. So they came out with loans, what we refer to as the DSCR or debt service coverage ratio, which is something that we would use for an investor, where if the rent exceeds the payment, then we're able to prove that you qualify. We have loans in the non-QM. We have loans for self-employed borrowers. Self-employed people, they own businesses. They write off as much as possible, and then it becomes difficult to qualify. So we're able to, for our self-employed borrowers, we're able to use bank statement loans where we look at your deposits versus, instead of looking at your tax returns. We're able to do that for 1099 income as well as real estate investors. So there's a fair amount of flexibility that we bring to the table with these different types of mortgages that are offered. So understanding your down payment and how much is needed. So with the conventional loans, Fannie Mae, Freddie Mac, we're able to get you mortgages with as little as 3% down payment on a conventional community lending program. Normally, conventional Fannie Freddie are looking for 5% down. The community lending, it may have some income restrictions and purchase price restrictions, but if you meet those, then we can do it with as little as 3% down. Conventional loan, the standard down payment is 5% down. So first and foremost, understand you do not need 20% to own a home. We can do it with as little as 3 or 5% down, depending on your income and your property value. So we also offer conventional renovation loans with as little as 3 or 5% down. Again, we can get you money to buy and fix the property, so it can be all in one loan. And fantastic program. If you're out there shopping for a home that is not exactly what you love, if it's in the neighborhood you want and it's in the right neighborhood and the right type of house, we can get you money to fix it up and make it perfect. Update the kitchen, the bath, or whatever else might be needed. FHA offers loans with as little as 3.5% down. And again, 3.5% down with renovation loans as well. So, again, it's the best renovation program that's out there is going to be your FHA 203K. If you're looking to purchase multi-unit properties, a 2 to 4 unit building, typically that FHA loan is going to be one of the best programs that are available. But we do have renovation financing for FHA as well as conventional. VA, again, as I mentioned, VA is 100% financing. It's 0 down payment for an eligible veteran, honorably discharged, or if you're an active duty military, you are eligible for that VA loan. So we have to look at the eligibility. USDA, again, 100% financing. That's going to basically is going to be in the rural areas. So it's not available in all areas, but if for the areas where it is available, it's 0% down, 100% financing for USDA. The non-QM that we talked about is a 10% down program. And for investors, for that debt service coverage ratio, investors do need to put 20% down, but it is possible for DSCR borrowing. So the next thing I'm going to talk about is what we call mortgage insurance versus homeowners insurance. Now, mortgage insurance is something that when you put less than 20% down on the purchase of a home, when you have less than 20% equity, the lender requires what we refer to as mortgage insurance. Now, that does not protect you, the homeowner, in any way. That actually protects the lender. So this is for conventional loans that if you buy a house, you get the mortgage. If for some reason you're not able to make those mortgage payments and the bank has to take that property back, then the mortgage insurance company would actually cover the losses to the lender. So it does not protect you in any way. The homeowner's insurance actually protects the property. So when you buy a house, you borrow money against that house. So we need to make sure that it's properly insured in case of, any sort of hazard, any sort of damage, fire or tornadoes or anything that could happen to that property. What is the collateral on your mortgage is the property itself. So we need to make sure that the proper homeowner's insurance is there to protect the property. So let me give you an example of what an FHA purchase would look like. So let's suppose that you want to purchase a home for $300,000. Minimum down payment with FHA would be 3.5% or $10,500. Traditional closing costs are going to be about 3%, so let's just call it $9,000. So down payment and closing costs in this example would be $19,500. Now, one of the things that we are able to do is we're able to, in working with your realtors, we're able to negotiate that the seller help contribute towards closing costs. So FHA allows that the seller can contribute up to 6% of allowable closing costs. So in this example, it would be $9,000. And for those of you who are starting out, you say, hey, you know what, I still don't have all that money that I need. And one of the great things about FHA is FHA allows you to receive a gift from a family member. So mom, dad, brother, sister, an immediate family member is allowed to give you a gift for some or all of your down payment requirements. So let's suppose that you get a gift from family for $5,000. So you could actually be purchasing a home of your own for as little as $5,500 out of pocket, and that's all you would need to purchase that property. So one of the things that we do, and when we go through your financing, is we look to see how much you have available and how much you need, and then we would work with you and work with your realtor to make sure that you're structuring your contract with the best possible terms for you. So as we move forward, FHA, or the Federal Housing Administration, has a program where you're able to purchase with as little as 3.5% down. As I mentioned, FHA actually guarantees the loan to the lender. Way back when the traditional lenders required 20% down payment, FHA came out with much lower down payment requirements, again, with that 3.5% down. Conventional loans, again, are loans that are written following Fannie Mae and Freddie Mac guidelines. So what that means is we write all of these loans following Fannie and Freddie guidelines. So we take your application, we process it, we underwrite it, we approve it, we close it, and then when it's all said and done, we deliver that loan to the investor, knowing that Fannie Mae and Freddie Mac will purchase that loan from us, and we're able to take our money and lend it to the next family to keep that dream of home ownership going. So the Fannie and Freddie own a majority of the loans that are written out there, and the part that Fannie Freddie don't do, that's where we make it up with FHA, VA, and USDA loans. So let's talk about the benefits of an FHA mortgage. FHA, again, offers a down payment with as little as 3.5% down, with as low as a 580 credit score. So typically when we're looking, excuse me one second. Typically when we're looking at a conventional loan, we're, the minimum credit scores that the conventional lenders, Fannie, Freddie, are looking for is going to be a 680 credit score. FHA allows us to go to as little as a 580 credit score. And they also allow you to go as low as a 500 credit score if you're putting 10% down. There's a few other guidelines that go along with that, but somebody can get into a home with as little as a 500 credit score with 10% down. FHA allows what we call a streamlined refinance, so that if you have an FHA mortgage and if you're making your payments on time, we're able to refinance that mortgage without having to qualify again. So if you're making your payments on time, they'll let you refinance, because again, if you can make your current payment now and the payment is going to be going down, then logically you should be able to continue to make those payments. So the streamlined refinance is a great way to utilize that FHA mortgage. FHA historically has very competitive rates. In your low down payment scenarios, the FHA rate is typically going to be a little bit better than the conventional Fannie Freddie rate. FHA also allows a higher DTI. DTI stands for debt to income ratio. So when the lender looks at your loan, they're looking to see what are your monthly payments for your house, and what are your monthly payments for everything, your house, cars, credit cards, everything. How does that compare to your total monthly income? FHA allows you to have higher debt to income ratios than Fannie and Freddie will allow. You can choose between a 15 to a 30-year fixed rate or an adjustable rate mortgage. We don't really use the adjustables very often. We much more prefer to see you in a fixed rate product where you know that your monthly payment will be the same for the term, or the rate will be the same for the term of the loan. There are down payment assistance programs that are available, and grant programs are also accepted through the FHA product. Excuse me. And as I mentioned before, FHA loans allow for the seller to cover up to 6% of allowable closing costs, which is a great option. The conventional loans with only 3 or 5% will only allow a 3% seller contribution. So that can also be a challenge for that conventional buyer. So let me talk about the down payment assistance programs. There are programs available. We do have access to them, but understand that they're typically going to have a slightly higher interest rate than your traditional loan program. There might be some higher points or fees. The credit requirements are going to be a little bit higher for that down payment assistance. Your debt to income requirements are going to be a little bit tighter. There are income limitations, and you may have to pay back some or all of that in the form of monthly payments. And there are purchase price limits to those programs. The other thing to be aware of when we're talking about down payment assistance is there is the what we call negative equity. What that means is when you're buying a home and you're using a down payment assistance program, you can actually owe more on the house than what it is worth. So let's just pretend you buy that house for $300,000 using a down payment assistance program. On day one, understand that you may owe $306,000, $307,000, $308,000 on that property. It's not that it's a bad program. It's just you just have to understand that negative equity can exist. So just be aware that you can owe more on the house than what it is currently worth or what you currently paid for. Excuse me. The grant programs. Now, grant programs are offered by local government agencies. They're often targeted to first-time home buyers or specific communities. That's something that community to community might offer different grant programs. They can help cover down payment, closing costs, or home repairs. Eligibility, again, may be dependent upon income, location, or other factors. Grants typically do not need to be repaid, and they may have a minimum time period in which you have to live in the home. So some of the grant programs require you to live in the property for 5 years, 7 years, or 10 years. Otherwise, you do have to give that money back. The grant programs want to make sure that they're helping achieve the goal of home ownership, but that they're not, they're not tying up their funds with people that did not intend to keep those homes. So let me give you a quick comparison between FHA to conventional. FHA, again, allows a purchase with only 3.5% down. The conventional minimum down is going to be either 3% or 5%, depending on whether it's a community lending program or not. Minimum credit score for FHA is a 580. Conventional minimum is 620. The debt to income ratios for FHA can go up to as high as 56.99, so almost 57% allowable ratios, where conventional is going to be limited to 50%. The purchase price limits or loan limits currently for FHA on a single family home are $498,000. Going up, you can see that each number is a 1 unit, 2 unit, 3 or 4. So you can go up to a 4-unit building for as high as $958,000, which is pretty generous, and you can do that with as little as 3.5% down. So if you do the math, somebody could go buy a 4-unit building for almost $1 million with 3.5% down, which would be $35,000, and you can finance the rest, which is huge. You know, if you look at a property that's going up in value historically at 3% per year, that first year that you own $1 million multi-unit building, understand that you get your money back for the down payment within 1 or 2 years in equity. So moving forward, conventional loan limits. Single family home just went up to 795,000. A 2-unit can be $1 million, 3-unit up to 1.2, and a 4-unit building we can go up to $1.5 million on a 4-unit building using a Fannie Freddie conventional loan. Again, the minimum down payment. Minimum investment requirement is 3.5% down for FHA, and conventional is 3 or 5%. So what are the things that you can use for, what can or can't you use for down payment and closing costs? So 401k or retirement accounts are allowed for down payment and closing costs. Selling personal properties such as a car, a goat, motorcycles, and jewelry. So I said goat. Yeah, some people said it's a typo. It should be a boat, but no, you could sell livestock for a down payment. So we do have to document it. We would have to document the value of it and the receipt that you actually sold it, but you can sell personal property for necessary down payment. You can get a gift from a family member, savings in the bank, stocks, bonds, yes. Credit cards, no, you cannot take cash advances on credit cards for your down payment requirements. A loan, you can get a loan if it is secured by collateral. So let's just say that you own a car free and clear. Now you want to go buy a house, you can go get a loan against that car, basically refinance that car, use that, and you can use that money as as acceptable down payment on the purchase of a home. Cash in your drawer, no, we have to be able to source where the money's coming from. If you have it stuffed in your mattress, it's got to stay there. We cannot use it for the purposes of purchasing a home. Or, can you get it, from a friend? No, you cannot. It's got to be, we have to be able to prove that it's coming from an allowable source as the ones I've mentioned before. So we've got, plenty of great reviews that you can reference online. And just to introduce you to the team. So meeting the team. So first and foremost, we are mortgage bankers. I talked a little bit about what mortgage bankers can do versus what your local banks can do. So we are mortgage bankers. I've been in the business since 1995. My team and I have financed over 10,000 homes. We've done over 500 renovation loans. Besides just our upfront sales team, understand that we also have a whole team of people that are behind us, the disclosure team, processing, underwriting, the lock desk, quality control, closing, funding, post-closing. All of these people are part of the team to help you achieve that dream of home ownership. So these are the people in the background are the ones that make us look good on the front. But understand that we have many, many, many years, pushing 30 years experience for both Mike and I have been on the front lines for quite a bit of time. So the first thing that we want to do is let you know that if you have any questions, please put it in the chat. We'll try to stop along the way, answer any of those questions. And Mike, did you put the link in the chat? So we're putting, there's a link in the chat, webinar.loyamortgageteam.com/book. That allows you to look at our calendar, set an appointment to have a one-on-one meeting with us so that we can look at your personal situation and see how to best get you approved for home ownership. And we also, again, not only home ownership for the first time, but any of you who are looking to consider renovation loans, or if you have the desire to become investors, real estate investors, we certainly love working with you as well. So again, in the chat is a link to our calendar. Please set an appointment with our team so we can have a one-on-one meeting with you. Mistake number 3 is not getting pre-approved. So when you first set a meeting with us, we're going to do a loan consultation, and we're basically going to, number one is take a look at your credit. So understand that credit comes in different shapes and sizes. Every industry Every industry uses a different credit scoring model. What does that mean is if you're going out to buy a car, the car dealer might pull your credit and give you one credit score, and that may be a different credit score than what we pull, simply because the risk of borrowing money for 5 to 7 years on a car is much different than borrowing money for 30 years on a home. So there's a different valuation that's given to that. So just be aware that not all credit scores are created equal. For the purposes of your income, we are looking for the last 2 years of your income in the form of your last 2 years tax returns, 30 days pay stubs. If your income includes overtime or bonuses, commissions or tips, we need to average that out over time. Your assets, we're going to be looking for the last 60 days of your bank statements. So, now is the time to take a look at your bank statements. If there's any large deposits, anything that we need to be aware of, it's better to fix it now before you go out and buy a house and go under contract. It's much harder to fix those problems after you're under contract than before. So we want to make sure that we determine how much of a house can you qualify for. And it's not just what we are able to approve you for. Understand, we also want to make sure that you're comfortable with the payment that you're choosing. So I might tell you, hey, listen, you qualify for a $500,000 payment or $500,000 purchase, but you might tell me that with the payment that you want to stay with, you might only want to be spending, $300,000. So that's part of the conversation that we want to have with you, is not only what can you qualify for, but what are you comfortable with. So making sure you're comfortable with your monthly payment and the amount of money that you need to bring to the purchase. We want to help you increase your bargaining power with the type of approval that you choose. We want to make sure that we estimate your monthly payments and your total investment, not just for what the bank will lend you, but what you are comfortable with. And we also want to talk about which is the best loan product for you. We've talked about many different products, and we want to understand your needs, your desires. Are you looking to purchase a house which is move-in ready, or are you looking to purchase a home in the right neighborhood that you might be able to fix it up a little bit and untap that hidden equity? So there's a lot of different things that can be part of that conversation. So the types of loan approval. So number one would be a pre-qualification. A pre-qualification is good, but understand that on a pre-qualification, everything is just verbal. We're basically looking at, you're going to tell me how much you make, and we're going to take your word for it. Pre-approval is better. We're actually going to look at your documentation, and the fast-track approval is best. What does this all mean? On the pre-qualification, we're using a verbal approval. Basically, you tell me how much you make. We may or may not run your credit. You can tell me how much your payments are, and we can take your word for it. Automated underwriting is not necessarily run. Everything is verbal, both income, down payment. It's the lowest form of qualification. We can give you a guess as to what you might qualify for, but understand that most sellers and most agents will not accept this type of qualification because they want to make sure that the information that we have been given has been validated. They want us to look at that information because when they go out and start negotiating on your behalf, they don't want any surprises. So pre-approval is where we take your information, we run it through an automated underwriting system called AUS. So we put all of your data into the computer, and the computer will tell us what type of approval you get. We will review your income, your pay stubs, your tax returns. We will review we will pull a credit and review it with you. Down payment, we'll look at your bank statements. We'll look at any gift funds that you may be getting. Where's the source of down payment and closing costs coming from? And we will look at all of that information, and we will give you a pre-approval based on having pulled your credit and run automated underwriting. This is a better pre-approval. And the best type of pre-approval is what we call a fast-track approval. On a fast-track approval, we're going to take all of that information that we have looked at. We're going to prepare your file. We're going to submit it to an underwriter who will actually issue a mortgage commitment. That's a promise to lend. So we will issue a mortgage commitment subject to appraisal and title. Your income is reviewed, your credit is reviewed, your assets are reviewed, and we actually make a promise to lend. So once we've done this, now you can go out, shop for a home, negotiate a contract, and knowing that the seller understands that you are in essence a cash buyer. The only thing we need is an appraisal and title in order to be able to close. This is the strongest type of approval. This approval will give the seller the confidence to accept your offer, and you're able to negotiate a faster closing and hopefully with much better terms. Your realtor now has the tools to be able to negotiate on your behalf, and this is the best type of pre-approval that exists. So what are the underwriters looking for? Lending is pretty simple. There's really 4 aspects that they're looking for. Capacity. They want to see, how much is your monthly income and what is your debt to income ratios in comparison to your monthly income. So how much is your house payment and how much is your cars, credit cards, student loans, any other loans that you might have. As we talked about, conventional wants to see you under 50%. FHA will allow as high as 57%. But understand that if we present a file to underwriting and you're at an 80% debt to income ratio, that's simply not going to work. So number 1 is capacity. We have to stay within the allowable guidelines. Capital. Where is the money for your down payment and closing costs coming from? As we talked about, what are allowable sources and what are not allowable sources. So capital. Character. That basically talks about your credit. Is what does your history look like? Do you have bankruptcies? Do you have a stable jobs? What is your education and your experience? So all of that is part of character. And finally is the collateral. So you're borrowing hundreds of thousands of dollars, and again, they're going to use the house that you are purchasing as the collateral for this loan. So I like to say is that it really comes down to, can they pay? Will they pay? And what if they don't? Can they pay is your capacity. Will they pay is your character. And ultimately, what if they don't? What if they don't? You don't make your payments. The bank is going to take the house back. But they want to make sure that the house that you're buying or borrowing against is worth at least what you're paying for it. So that's where the bank protects themselves. And they're looking for the value of the house must be at least what you're paying for it. The condition has to be in acceptable condition. So they don't want to be financing houses that are falling apart simply because if they have to take it back, now they have to be in the rehab business in order for them to get their money back. And there's different risks with different types of properties. Single family homes has a different risk than a multi-family home in terms of, apartment buildings are different than houses. That's just how it is. So, and the other thing is the title search, making sure that we are in first lien position. When we lend you money to buy a house, we want to make sure that the collateral is there and that there's no liens against that title that can cause a problem. So these are all of the things that the underwriters are looking for in determining, is this a loan that we are able to do, evaluating all of that risk. So when you're out shopping for a house, number 1 is do schedule a loan consultation. To use that link, schedule an appointment with us. Call us if you have any questions. Continue to live at your current residence, continue paying your mortgage or rent, continue using your credit as normal, keep, the same job. Don't be switching jobs if you're trying to buy a house. Keep your same insurance, stay current on all of your existing accounts. So again, you might have a, great credit score, but all of a sudden you miss a payment that can cause severe problems. So, stability is one of the biggest things that we're looking for. Things not to do. Again, like I say, don't pass go, don't collect $200, don't make any large purchases, don't change bank accounts or make large deposits, don't, transfer balances. Just you got to leave things where they are unless we direct you to do something. Just don't do it. Don't close credit card accounts that could affect your credit score. Don't consolidate your debt or move things around unless we're giving you direction to do it. It's important to keep things alone. Leave things alone. Don't apply for new credit, or don't get excited and go out and buy a car. Don't co-sign for anything. Don't change or quit your job. Don't max out or overcharge your credit cards. And don't pay collections without talking to us. One of the things that is a misconception is, oh, there's a collection on your account, been on there for years, and you decide to go out and pay off that collection. That could actually have adverse effect on your credit score because it went from a dormant account all of a sudden to a new account, and it destroys your credit score. So please do not make any movements without talking to us, and we can guide you down this path. Mistake number 4 is not working with a buyer's agent. So one of the things which is really important is you want to make sure that you have the right team on your side, and part of that team is going to be your buyer's agent. Why should you be working with a buyer's agent? Understand that these people do this for a living. They have it's expert guidance and market knowledge. They have access to listings, including off-market properties. There's a system called the private listing network. So realtors actually have access to properties that they don't release to the general public, but only realtors have access to those. And a lot of the great deals are hidden within the private listing network. They offer expert negotiation skills. So understand, you as a home buyer, this is the first transaction that you're doing. You may purchase, over your lifetime, you may purchase 3, 4, 5 properties, but skilled negotiators like buyer's agents do dozens of transactions a year. And, again, it's a great resource in your corner. They offer objective advice. They're able to look at the current market and, what is this house worth in today's market? If you invest some money, you fix it up, what could it be worth tomorrow? They can give you statistics, historical market data by neighborhood, by town. There's a lot of different data that they have access to that they're able to guide you in the right direction. They're experts at handling paperwork and legalities. There's a lot of customs that go on in the marketplace, and if you're again, if you're not working with a strong buyer's agent, again, it could cause some serious challenges. They also have connections to the right professionals, the right home inspections, the inspectors, the right attorneys. Not all attorneys are created equal. There's attorneys that specialize in real estate. We want to make sure that you're working with a real estate attorney who really understands the customs of the marketplace. Buyer's agents can save you time and stress. They understand this process and they can guide you in the right direction. They can advocate for you in complex situations. Understand that, you're going to go out there and look at a property, maybe do a home inspection. There's some issues that come up on the home inspection, and they're going to help guide you in negotiating and renegotiating that transaction as necessary. And they can also take into consideration or help you understand future resale values. Again, every real estate is local. You have to understand the local market. What's happening in Aurora doesn't necessarily correlate to what's happening in Gurnee. So you want to make sure that you're working with an agent who has local real estate knowledge. Why you should be working with that buyer's agent ensures that you have a knowledgeable ally on your side, working to protect your interests and guide you through the complexities of purchasing a home. So when we're dealing in real estate with the agency laws, the buyer agency agreements, you're basically, it's like you're picking teams. Who's on your team? Are they working for you? Are they working for the seller? It's very important to understand who that agent is working for. So recently, there was a lawsuit against the National Association of Realtors, and the issue was that traditionally the home sellers, the homeowners were paying a certain commission to their listing agent, and the listing agent would share that commission with the buyer's agent. Well, there's a big lawsuit over it, and what ended up happening is there was a settlement with the National Association of Realtors, which basically stipulate that before a buyer's agent, before a realtor will show you a home, they need to enter into a buyer's agency agreement with you. So they need to have a written agreement, a written contract as to how they are representing you and how they are being compensated. So you cannot assume that the seller's agent is compensating your buyer's agent anymore. So that's something that has to be discussed, and it's something that has to be done in writing. And so the options are basically that the buyer's agent is being paid by the buyer, or is being negotiated that that fee is being paid by the seller. But again, it's something that needs to be discussed with your buyer's agent. We're not here to negotiate that for you, but just so that you understand that there is this necessity to have a buyer's agency agreement in place, which stipulates how your agent is being compensated. Okay, so it's not as simple as just, hey, show me the house, and you can assume that their commission is being paid, because it's not that simple anymore. So the other part, which is very important, is when we are talking to you in your loan consultation, we need to understand where you stand, that you might be in a situation that you're saving money to come up with your required down payment, and we need to negotiate that the seller help cover your traditional closing costs. And now we also need to discuss, do we need the seller to cover the buyer agency commissions? And it's all all of this can be discussed, but we need to understand it up front. So again, it's a little I know that this part can be a bit confusing, but it's just important to know that it's something that you must discuss with your agent. We have some great agents available that we can connect you with, but it is something that regardless of who the agent is, you will have to discuss the buyer agency agreement. Basically, it's stipulating who's on your team, who's working for you, and who's not. If you go to an open house, understand that the agent is that agent in the open house is representing the seller. They have no fiduciary responsibility to you. They're being paid by the seller, and their interest is in protecting the seller. So again, you need to make sure that you have somebody on your side. And if you have a buyer's agency agreement signed, even if you go to an open house, you tell them that you're being represented by your agent, and your agent would get you all the necessary information. Again, reviewing the commission obligations with us beforehand. So if you sign an agreement with your agent and you say, help me go out and buy a house, and I'm willing to pay for your commission, we need to know that, because we need to calculate how much is your down payment, how much are your closing costs, and then how much are the commissions that you agreed to. We need to be able to show where all of that money may be coming from. Now, understand that there can be flexibility in the agreement. So you have the right to know this, that the agreement does not have to be a long-term commitment. The agency agreement could be as simple as just, you only want them to represent you for one house. You only want them to represent you for 24 hours or 30 days or whatever time period you and the agent agree upon. Understand that you don't have to be tied into a long-term agreement. Flexibility is your right. So just something that you need to be aware of. It's a new wrinkle in the home buying process, that you do have to have a buyer's agency agreement in place. Again, let's stop for a second. I need to take a quick sip of water. If you have any questions, please put them in the chat. And also, please use that link to schedule an appointment with the team if you haven't already done so. Okay, so continuing to move forward, mistake number 5 is skipping a home inspection. So, the cost of a home inspection might be, let's say, about $450, but skipping that home inspection could cost you $20,000 in the long run. When you purchase a house without a home inspection, you may be. You have something, Mike? No. You may be purchasing a home that could have structural issues, electrical issues, plumbing issues, or other health and safety issues. You risk inheriting, issues such as mold, radon, carbon monoxide. You also without a home inspection, you are not becoming aware of what repair costs might be. So if you're working with the right home inspector, they're going to do that home inspection and they're going to tell you what are the deficiencies in that property and what is the cost to repair those deficiencies. So that's important. And you can lose negotiating power. So if you put a house under contract, you do a home inspection, and once you have that home inspection, what are the things you need to negotiate that the seller repair or fix or reduce the sales price, and it really gives you something to negotiate with. And it also having a home inspection helps you establish a list of items that you may want to repair in a renovation loan. So once we know what's wrong with the house, you might come back to us and say, hey, listen, I still want to buy the house, but I need a little bit more money to fix this, this, and this. The seller is going to drop their price, but I still need to fix these items. So we can help you get money to fix up those issues. So again, let's stop for a second. Mike, do we have any questions that we want to address?
Been answering some questions in the chat already, and the pros of FHA, which we kind of discussed in the slides already, and about if we did DSCR loans, which we do.
Okay, so real quick, I see. So Emery, what are the pros and cons of FHA versus conventional? Again, one of the things is not everybody's situation is created equal. FHA offers a little bit more flexibility in regards to debt ratios and credit scores. Conventional is, going to require slightly higher. And it also depends on what price point you're trying to be at. Why would we do a conventional loan instead of FHA? Is if we need to get to the larger loan sizes, and understand that FHA's maximum loan currently is $458,000 versus conventional. What's our loan limit, Mike, on conventional? $795 now.
It's still 766, I believe, but it is going to be going up soon. We can actually do 790.
Right. So again, might be an issue of we need a larger loan. That's why we're going conventional versus FHA. But every situation is different. What I encourage you to do is set up an appointment with the team so that we can look at your specific situation. Christina asked, do we do the DSCR loans? Absolutely. That was part of the presentation. Those, again, debt service coverage ratio. If the payment is if the rent is higher than the payment, then that property qualifies for the DSCR. HMLs, Mike. She asks about
hard money loans.
Oh, hard money loans. Okay. Yeah. We also have access to hard money loans, commercial financing that's very much more for investors. So if you're looking to buy and fix a property, so buy, fix, and sell, that would be a commercial loan rather than a residential loan, but we can help you with that as well. And then what else do we got? And Emery says that's the answer he was looking for. Thank you. And thanks, Emery, for being here. So moving forward, again, hopefully we've answered your questions. If you have any other questions, feel free to put them in the chat. And again, I encourage everybody to set an appointment on our calendar. The link is in the chat. The best way for us to discover any challenges that you might have would be in a one-on-one appointment. So let's recap what we talked about is, number one is understanding your financing options. I know I threw a lot of stuff at you. That's what Mike and I are here for. We've been doing this a really long time. We can break this down. We can make it simple. So understanding, getting to know your financing options, getting pre-approved before home showings is very important. Not just qualified, not just pre-approved, but we want to get you a fast track approval, which is basically a commitment to lend subject to appraisal and title. That will give your agent the strongest negotiating power to know that you're already approved. Don't just go to your bank for mortgage advice. Understand that the local bank, the guy at the bank, he's helping you open a checking account. He's helping you get a car loan. He's doing a whole lot of stuff, but he's not necessarily a mortgage expert. All Mike and I do are mortgages. We have no clue on how to help you get a credit card, but we can certainly help you get a mortgage. Not having an agent represent you to ensure that they have your best interests at heart is super critical. If you're thinking about buying a new construction home, also, it's important for you to be represented by a buyer's agent. Do not walk into the new home sales office without an agent, because understand that the people in the sales office are working for the builder. They will eat you alive. Very important that you are represented by an agent. Don't skip the home inspection. There's a lot of issues that can come up in that house. You want to make sure that the house is safe and secure for your family. There's no hidden dangers. And if there are some issues, the home inspection will give us the tools to be able to negotiate a better price on your behalf. The biggest mistake of all is continuing to rent. Again, we talked about the net value of a homeowner is $248,000 greater than a renter. The biggest mistake is to continue to rent. You cannot hedge yourself against the cost of the inflation. The cost of everything continues to go up. If you're a homeowner, your house is going up at the same pace as inflation, so you can at least defend yourself. So again, the biggest mistake of all is not being a homeowner. Again, we certainly hope that you found today's content is interesting and valuable. A couple of things. Mike and I do this presentation every 2 weeks. If you know of anybody who is looking to make a move in real estate, we do ask you to share the link, the original registration that you received or you should have received, and invite a friend. So, please share this with your friends. We want to get as many people educated as possible. We do this as a community service. We certainly don't charge for it, but we want to make sure that people have this information. A couple of things that I'll put that if anybody, I will be doing a webinar for credit improvement. If anybody is interested in specifically being invited to the credit improvement plan, do me a favor in the chat, just put credit so that we make sure to invite you to that credit improvement plan. So again, one of the things that really dictate mortgage interest rates is your credit score. The stronger your credit score, the best interest rate that you're going to get. So we want to take this time. We can do what we call a credit simulator, where we can look at your credit. We can look at your credit and give you some tips, some hints on what to do, what not to do to increase that credit score the maximum possible, so that when you are going to contract, we're able to secure the best possible rate for you. So, Mike, if you can make a note of the folks that put credit in the chat, so that we can make sure to include them in our credit improvement class. And then finally,
Hey, Juan,
yes, sir.
can you go back to the last slide? Jasmine would like to see it again.
This one?
Yes.
Okay.
I believe so.
So, Mike, if you can make a note of who put credit in the chat, so we can make sure to include them for our credit improvement plan. And then the other thing that I'll bring up is our renovation loans. So we are going to be doing a renovation seminar webinar, where we are going to talk about the power of renovation, where you're able to get money to buy and fix that home, to maximize the value, to untap that hidden equity. Depending, not everybody is up for a renovation. But if you're open to buying it, fixing it, if you could buy it for 300 and put 50,000 into it, and it's worth 450, that $100,000 in equity is yours. It's added value in your home. It increases that net worth. So Emery got ahead of me, so he put in renovation in there. So we make sure that we invite Emery to our renovation class. If anybody else is interested in being able to buy and fix a home and untap that hidden equity, put renovation in. We'll invite you to that class. And again, it's just an added community service that we want to offer you. But we're understand that we're able to help you get financing for that perfect move-in ready home, a new construction home. We can help you get financing. If you want to get a house where you can buy it and fix it up a little bit, can be a little rehab, a lot of rehab, and even for those of you that have family members who, they love their house, they love their neighborhood, they want to stay right where they are, but they want to put a, second story addition on the house. We are able to do renovation refinances. So please, pass our information along. We always do appreciate those referrals. But we will make sure to invite you guys to the credit improvement class, and as well as the renovation class as we put those on. As I mentioned, we do this first-time home buyer seminar every 2 weeks. So anybody who's looking to make a move, feel free to invite them, and we will add them to the list. In the meantime, make sure that you're taking advantage of our one-on-one consultation. There is no charge for that. One thing, Mike, that I neglected to mention, I think this, and I'll blame it on you. You were supposed to say it. Anybody who sets up an appointment on a one-on-one consultation, that consultation will be with Mike, and he will actually give you a $500 credit for closing costs for taking action today. So just anybody who wants that $500 credit in the chat, just simply put 500, and we will make sure that you get that $500 lender credit when you set up that one-on-one meeting. Emery's all over this.
Yes.
Right. So that's where we're at. Take advantage of that one-on-one opportunity, and we'll make sure that you get that $500 credit. We will, again, some of you were referred to us, came to this webinar by one of our very valued realtor partners. We'll go ahead, get you pre-approved and get you connected back with the agent who referred us. If you need an agent, let us know, and we can connect you with a local area specialist who as we said, with the buyer agency agreement, they by contract, they will represent you for your best interest. And again, they do have fiduciary responsibility to put your needs ahead of theirs, ahead of everyone else. by contract, they would be working for you. So if you need an agent, make sure to let us know. We'll be happy to connect you with one of our local area specialists. We work with the best agents around. But we certainly thank everybody for taking the time to be here. Mike, do we have any other questions?
I don't think so, and I think just about everyone grabbed the $500.
All right. That cost me a ton of money, but I'm happy to give it. Certainly excited to help everyone achieve that goal of home ownership. This is step one, is to help you get your first property. But then from there is, real estate is a great way to build wealth. We can also help you become real estate investors. We can help you build a cash flow portfolio. It's rather than paying rent, is starting to collect rent, is a fantastic way to create wealth. But that's a different topic, Mike. We won't go into that. Anything else to wrap this up with? Guys, thank you, everybody. I wish everyone a great night, and thank you for participating.
Yes. Thank you for spending your evening with us.
Absolutely. Thanks, guys.